is Colin Cattell with Palisade Radio. Over the past few weeks, investors in the general equities and in the mining sector have witnessed volatile markets. By some metrics such as the HUI, gold stocks are once again at an all-time low for the bear market. Many analysts have altered their outlook in light of these new developments, and here to share his outlook on the sector is Jordan Roy-Byrne of the Daily Gold. Jordan, welcome to the program.
Colin, thanks for having me.
This year we witnessed a springtime and summertime rally in the miners. Both of those fizzled out and we're back to the same bottom we've been bouncing off of for over 16 months now. There have been claims of a triple bottom playing out in gold, and when I asked you about this, you said triple bottoms simply do not exist. Furthermore, there have been a pattern of lower highs developing throughout gold's bottoming process. All this leads you to believe that gold will make a new low, yes or no?
Yes, I do think it's going to make a new low. Would you like me to expand upon the reasons?
Absolutely, and why do triple bottoms not exist?
Well, triple bottoms, the only pattern that can be a triple bottom is when you have a head and shoulders pattern, which can occur at a top or a bottom. And within that pattern, let's look at it from a bottom. You typically have one low, and then you have the market at the second low. It'll go lower, but it's kind of a false low. And then the third low, of course, isn't as low. And so within the head and shoulders bottoming pattern, after the first and the second bottom, the rally will typically go back to the same point. So, for example, let's say that gold makes its first low, it rallies back to 1400. Then after the second low, it should rally back to 1400 again. And then after the third low, which is higher, then it goes above 1400. Now, looking at gold, we have not seen that. What happened after the first low that you had in summer 2013, gold rallied just above 1400. Then we made the December low. That rally, that next rally peaked in March. That was below 1400. So it didn't go high enough. It made a lower low. And then also this summer, gold peaked, I think, just below 1350. So if this was really an invert bottoming pattern, what you would have seen is this summer gold would have risen above 1400 and had a clear breakout. And so obviously that didn't happen. And gold just looks very weak here. Looking at it, you can draw a down trend line starting from the middle of 2013. And what you'll notice is that this summer gold failed to rally back above that trend line. So that shows weakness. And since that point, I believe gold was down, looking at the chart, it was down something like 9 out of the last 12 weeks. And in addition to that, silver was down 11 out of the last 12 weeks. And furthermore, the stocks were down 5 weeks in a row up until this recent low, and the stocks were super weak in September. So the market, looking at gold, it failed to rally up to the trend line, so that showed weakness, and then the market got really, really oversold. So what we've seen in the last couple weeks is basically kind of a reflex rally. The sector was really oversold, and it needed some time to have a rebound because things don't move in a straight line. And so with respect to a triple bottom, going back to that, as I said, the only kind of triple bottom you see is that head and shoulders bottom. That's already completely failed. There's no question about that. I mean, nobody who's a professional technical analyst would disagree with what I'm saying. This is just what the facts are as far as textbook technical analysis of this pattern. Now, the only time that I really see triple bottoms occurring is over multiple years, like looking at maybe something makes a double bottom and then maybe 18 months or 2 or 3 years later, then it comes back down to test those first two bottoms. So in the short space of time that we're in, you just rarely have triple bottoms outside of, as I said before, the inverse head and shoulders bottoming pattern. So that's where we are now. The market looks very, very weak. And the last thing I'll add is with respect to the stocks, I was bullish earlier this year because the stocks were leading gold and the stocks got extremely oversold at that December bottom. But unfortunately, what happened in September, if you look at some of the articles I wrote leading up to it, in August, I was mentioning how September is very, very important because September usually sets the tone for the rest of the year. And the stocks were at a point where it was clear they could break out in September and then have a big run into the end of the year, and then that would be it for the bear market. Confirm that it's over. And I was expecting, to be honest, I was thinking that was going to happen. The stocks were holding up, even though gold was looking kind of weak. But after the first week of September, the stocks failed to break out. They had a strong reversal. Then I wrote the article, failed breakout augurs for rough September. And since then, things have just gone down terribly. And I know we're going to talk about the analogs later. But Colin, we've had a lot of discussions over the last year, and I was very positive on the stocks, but the issue with gold and its analog was that there wasn't a overwhelming case that gold's bear market had ended. Now, looking at the stocks, I really thought that their bear market had ended, and for many stocks, that still may be the case. But gold's the question of has gold bottomed or not, there wasn't as strong of evidence there as there was with the stocks. So, I mean, to get back to the second part of your question, we've had a reflex rally in the sector. Gold has actually rallied about $70 from 1185 to 1250, 1255. But the mining stocks have done absolutely nothing. They've looked really, really weak. Silver has barely rallied also. And those factors are just very, very negative, considering the market is in a bear market, in a downtrend. To be honest, it reminds me of what we saw in the fall of 2008. I'm not saying we're going to fall 40 or 50% from them, but to a small degree, I think it's kind of reminiscent of what we had in 2008 before we had the final bottom there.
A couple rapid fire questions for you here, and I'm not going to hold you to these numbers, but just to give our audience an idea of the downside that might exist in your mind. What's your downside target for the HUI?
Well, the HUI, last I posted, let's see what it closed at today. It closed at, it looks like about 184, 184.4. Looking at that, I would say, I posted a chart editorial today. The first strong support is 168, and that's strong support as far as the weekly chart. So we could go below 168 intraday or during the week, but that's weekly support. And then also I'm looking at just above 150. That's support that dates back all the way to 1997. In other words, if you draw a line on the chart, you can see that it was an important pivot point in many years, dating back over the last 17, 18 years. So I'm looking at 155 to 168, but just to make it more round numbers, we could say 155 to 165. That's the area of very strong support on the chart.
And the GDXJ next?
GDXJ, looking at that, today that closed at 30.95. We'll round up and say 31. Its low is, I believe, 28.9. It's tough to say, but it looks like that's going to move to a new low. I would say if there was a person who reconstructed the chart several years ago to go back to before 2008, and I think the 2008 low was around 24 or 25. So if I had to guess, I would say 26 or 27.
And finally, what about gold and silver?
Well, my targets for gold and silver, with gold, 1080 is the first strong support. The major breakout, of course, was above 1,000. So 1080, I think, is going to be the first support, but I don't think it's going to bottom there. I think I would look for a bottom around 1,000. And for silver, the strong support is at 15, but I wouldn't be surprised if silver dips below 15 to maybe even 13 or 14. So that's something that we have to keep in mind, that there are strong targets, but on a short-term basis, as far as what's happening each day or during the week, you can see these markets kind of make a spike low and then come back up.
And then let's talk quickly about the general equities. 2 weeks ago, they suffered a bit of a rough week. Nothing catastrophic in terms of the percentage drop, but the upside channel that was very strong for the past 3 years was broken to the downside, as well as the 50-day and 200-day moving averages. Both of those were crossed. As soon as this drop-off occurred, we had the heads of the Federal Reserve stating that interest rates would remain at zero further stimulus was not off the table, and lo and behold, the market is on its way back up. Thoughts on that?
Well, my thoughts are that we're seeing a reflex rally in the general equity market. It got very oversold as far as a short-term sense, and now it's having a sharp snapback rally. I don't know. I mean, I think it's very possible that we've entered a bear market. I'm not 100% sure. It's just very difficult to gauge, but it looks like it's possible that with the general equity market, we've begun some kind of a topping process. Now, I'm not looking for a 50% bear market like we've already had. After you have two 50% bear markets in a 9-year time frame, it's just very unlikely that you're going to get another severe bear market. I would say maybe 30 or 35% could be the bear market that's coming. So I don't think there's a huge risk that the market's going to fall apart over the next 3 or 6 months. But I do think that the upside is very limited. I think it's possible that we could have begun a topping process, but we can't really confirm that probably for another 6 months. It's just hard to tell.
You've stated in the past that in order for a bull market in gold to take off in earnest, we probably need to see a breakdown in the general equities. You're saying that bear market might have started, but if the Fed is going to continue to manipulate, how can investors expect this gold bull market to resume anytime soon? I guess on the one hand, we can say that the effectiveness of QE at some point will wear off, but it's been going on for so long now that investors, I guess gold investors, seeing the Fed pumping, are losing faith that the effectiveness will wear off.
Well, I mean, as you know, technicals lead the fundamentals. So when we're looking at market events, that's secondary to looking at the charts. Looking at market events and what could kind of turn these trends around. At some point, we've been so used to bear markets being caused by recessions, deflationary forces. I think at some point we're going to start to see inflation. I mean, if you're looking at what's happening in Europe, they're obviously having problems there. Japan, because of its debt situation, really needs inflation. Europe needs inflation. We also need inflation. The Western world is hugely indebted, and the issue with that from a government standpoint is you need inflation to be able to, I don't want to say pay off the debt, but really you need inflation to push the real value of the debt down. Because if you have deflation, that's a debtor's worst nightmare. The value of the debt goes up. But inflation pushes the real value of the debt lower. And so that's what we really need to see. We need to see nominal GDP growth growing more than debt. And how do you get that? You get GDP growth plus inflation. And obviously, we haven't been getting much growth, so we need to see inflation. And so eventually, I think what's going to happen is you're going to see more of these, supposedly stimulative policies, and because they want to see inflation. But what could happen is we start to get inflation, and then we get a lot of inflation, and there's nothing they can do to hold it back. And when you get inflation, rising inflation, that's bad for the stock market, especially when you look at the stock market. It's already gone up for 5 years. The S&P is up 200%. It's tripled. It's a different thing when we're coming out of a huge deflationary bust like 2008. So at some point when you get inflation, that's bad for companies. Their costs are going up. I mean, we saw this happen with the market in the late 70s. Of course, then you had a bad recession in the early 80s. This also happened in the late 1940s, and we had nearly a 30% bear market then, with nominal GDP going up a little bit. So I think at some point you're going to see a lot more policies intended to bring about the inflation that all these central bankers want. And then that's going to be the point when we start to see precious metals outperform again, commodities outperform again, and then the general equities market kind of struggles. But obviously, we're just completely speculating here. But I do think it's something that is possible and that could turn precious metals around. I mean, what we need to see is more weakness in the S&P, more weakness in the global economy, and that will, of course, bring about more inflationary policies. And I think after that, that's where we're going to start to get inflation. Obviously, markets move ahead of these events, and so gold and precious metals and mining stocks are going to start to perform well, before all those things start to take hold. But again, fundamentals are always changing, and the answer is just speculation on my part. It could be right, it could be totally wrong, but that's kind of what I'm thinking at this point.
And you just answered what my next question was, so I'll turn it into more of a comment. And that's the Federal Reserve is going to want to pump until it causes these obvious side effects. And the only side effect I can imagine that would cause them to stop pumping would be runaway inflation. It's kind of hard for investors to see that happening right now because a lot of people in the gold sector thought that inflation would have occurred years ago already with how much money's being created. But let's move on to the next question, which is about the gold bear analog chart. You've created a gold bear analog chart that you've been putting on thedailygold.com, and I'll direct listeners to your site to take a look because it's very, very insightful to look at. It compares all the historical bear markets in the junior mining sector and compares them to the one that we're witnessing today. As we enter the fourth year of this bear market, how do we compare at this point to the ones in the past?
That's a good question. Well, looking at the gold bear analog chart, if you take out the longest bear in terms of time, which lasted 5+ years, that was actually a very mild bear. I think the percentage decline was 35 or 36%. And also, if you take out the 80 to 82 decline, that was a huge bust, over 60%. I'm looking at the chart. One thing I did with the chart is I plotted every bear on the same scale as the current bear. So looking at this on the same scale, the 80 to 82 bust, that only lasted less than 2.5 years. Gold bottomed at 687 as far as the scale. And then using the same scale, the aforementioned bear market, the 87 to 93, gold bottomed at 1251. Bear markets are a function of price and time. So the more severe bear markets in price usually only last 2.5 years, some even less than that. So they don't last that long. The more severe bear markets in time, they tend to be less severe in terms of price. So when you take out those two bear markets, the extreme ones as far as price and time, I'm left with three other bear markets to compare the current one to. Now, two of those were very sharp as far as price, but not time. There was one from 83 to 86, or 83 to 85. That was a 2-year bear, and a little bit more than 2 years. That bottomed at 1064. Of course, the 75 to 76, that was only about 20 months, but that bottomed at 994. And then the other one, which is very comparable to the current bear market, that's the 96 to 99 bear market. That one bottomed at 1147. And if we're looking at the same scale as the current one, then that one bottomed just after March 2015. Looking at gold now, of course, it's easier for the audience to understand this when they're looking at the chart, but it's kind of following the path of the 96 to 99 one. Again, that bottomed at 1147, March 2015, if we're using the same scale. I think gold is going to bottom before then, but looking at this chart, I mean, it makes an argument that it could bottom somewhere below 1100. And on this chart, I'm using weekly data. So if you're looking at weekly data, and I say gold's going to bottom at 1050 or 1060, that's just the lowest weekly close. Gold could have a lowest weekly close at 1050, but the next week gold could go down to 1,000, and then it could close the week at 1070, and that would be a huge reversal that week. But if you look at where was the lowest weekly close, it was at 1050. So I just want to make that clear for the audience. But this chart, it coincides nicely with looking at gold and how it has that strong support around 1,000. So, I mean, that's kind of what I'm thinking at this point.
So, if we were able to create a perfect equation that incorporated both time and severity of the drop in the bear market, are we at the worst bear market that you've looked at, or are we in the middle? Where are we at compared to the other ones?
Well, Colin, that's a really, really good question. I haven't created an equation, but looking at we're the current bear market it's severe. It's close to the most severe if you're accounting for everything. And part of the reason for that is we had a really long run from 250 to 1900 over 11, 10, 10 years. And the worst we had was a quick 30% drop in 2008, and that only lasted 5, 6 months. So that's the reason why we're having a very severe bear market now. But it's a little bit more severe in terms of time, but not quite as severe in terms of price. So I mean, that's where we are. It's going to be in the middle, I think. As far as well, let me say this: as far as time, it's a little bit more severe than the average, and as far as price, it's going to be a little bit more severe than the average. So, I mean, compared to the other bear markets, that's what I see, and I hope that answered your question.
Once you made the bear analog chart, you went ahead and examined the bull markets that form after those bear markets occur, and you averaged that data together in order to take a guess at what the bull market will look like coming out of this bear market and what type of gains investors will see, say 6 months out, a year and a half, and so on. What can you say about that at this point?
Well, looking at gold, what I did was I looked at the four strongest cyclical moves in gold. So we're talking about how gold performed over a 3 to 5 year period. So I looked at these moves that started in 1970, 1976, 2005, and 2008. And what's interesting is, let's just say gold bottoms at a weekly low of 1050, and that happens in the middle of January, so a little bit less than 3 months from now. If it follows the average of those four, the analog shows that gold would reach. I'm just eyeballing it. That gold would reach above 1350 in the next 4 months after the bottom, so that would be May, and that gold could reach. It would reach 1500 by January 2016. So if gold bottoms at 1050, it could reach 1500 12 months after that. But Colin, that's the average of these four recoveries. Now, the two strongest recoveries were 1976 and 2008, because that's when gold was the most oversold. If I'm correct and gold breaks below 1200 and bottoms at 1050, it's going to be very similar to those two bottoms. And looking at those two bottoms, the potential rebound on this scale would be from 1050, again, January 10th, to above 1400 by the middle of May, and then possibly up to 1500 sometime in the summer. Now, looking further out, looking at this chart, assuming we do bottom in the middle of January at 1050, it projects that we would get back to 1800 sometime in the summer of 2016. And then it projects that we would go above 2000 the end of 2016 or early 2017. It projects that the market, as far as when the market's really going to start to take off and when will we have a lot of momentum, the projection of that starts kind of in the second half of 2016. Then you get a pullback in the first half of 2017, and then after that, that's when gold really starts to move. I mean, looking at this chart, it says that gold could go as high as 2,200 in March or April of 2017, and then possibly up to 3,000 by the end of 2017 or early 2018. But to come back to kind of the more near term, what this chart shows is that if we do go below 1100 and make a weekly low at 1050, obviously, Colin, that's going to be terrible. I mean, the stocks are already super oversold, and we're talking about another big breakdown. So, I mean, some of these stocks are going to get completely pillaged, and even good companies can fall another 20, 25%. But looking at this analog chart, it tells us that in the next year after the bottom, we should see a rally back to 1500, maybe higher than that. And even in the first couple months after the bottom, we could see a rally back to 1350 to 1400. So the negative is I'm looking for a final breakdown, but the positive is if we do get a final breakdown below 1100, when we make that bottom, history suggests we're going to have a strong rebound right away in the next couple months. Not the next couple months now, but the next 3 or 4, 5 months following that bottom, we could see a rebound up to as high as 1400.
When I spoke to Rick Rule a few months ago, he believed that the bottom was in the junior sector, but said that in past bear markets he had experienced this no bid environment where, for example, if gold crashed to 1050 right now, a lot of these micro stocks that I speculate in might drop to a penny just because there's nobody there to buy them. And it looks like, maybe Rick's changed his mind, I don't know, but it looks like at this point we might actually hit that extreme low point. In any case, we've been talking for quite a while now. Is there anything else you'd like to share with our listeners before we let you go today?
Well, two things. I mean, the one thing I want to mention is I do think there's a lot of good junior companies out there that have already bottomed. They just went so low in the middle of 2013 or maybe December 2013 that some of these stocks that have rallied 100, 200%, those stocks are not going to make new lows. So looking at these indices, they're obviously appear likely to make new lows, but that doesn't mean that every single junior stock is going to make new lows. I mean, I have a top 40 index that I follow, and it's generally speaking 40 of my favorite companies. It has a median market cap of about 500 million. This index would have to decline more than 20% to make a new low. It probably will make a new low, but I don't think it's going to make a severe new low. But that's a basket of 40 companies. So I think there's going to be a fair amount of stocks that don't make new lows. Secondly, I mean, something we discussed earlier, the real fundamental key for gold is negative real rates. And so what has coincided along with the severe bear market we've seen in the last couple of years is there's a belief that interest rates were going to be going higher. And of course, inflation wasn't really a problem. It peaked in 2011. So because of that, there was less of a need to own gold. Gold is an alternative currency. And when people can't earn a positive real return on their money, that's why they go to gold. And so in the long run, what's going to push gold into a bubble, in my opinion, is the economy needs negative real rates. Governments need negative real rates. That's how we have to get this thing stimulated and how we have to get to a point where the value of the debt can be pushed lower and we can get out of this debt mess. And eventually, when we start to see inflation taking hold, because of the huge debts that governments have, they're not going to be able to raise rates high enough. In other words, if we have 5% inflation, normally you'd want rates at 6 or 7%, and that would be terrible for gold. But because of the debt that governments have, they're not going to be able to raise rates that high. Maybe they'll have rates at 1.5 or 2% or 2.5%, but they're going to keep rates negative. And so in the long term, I think that's what's going to cause the bubble. And kind of in the near term, that's what we need. We need to have central banks all over the world pump more money in. That will push rates lower and push inflation expectations higher. So that's kind of what will help turn this thing around, over the next 6 to 12 months in terms of fundamentals. And because technicals and market action leads that, maybe we can expect a bottom in the next 2 to 4 months. Those are some thoughts. And then the last thing I'll mention is this final decline that I'm projecting and some others are projecting, this is what will facilitate the junior sector having spectacular rises out of the bottom, like we witnessed in 2001 and 2008. And the last thing I want to mention is that this huge decline that I'm projecting, with the potential for gold to go below 1,200, make a bottom at 1050 or 1,000, that is what's going to facilitate the huge rises that we see coming out of bottoms. Remember, Colin, over the past year, we've kind of talked about, maybe we could get this kind of saucer bottom and the gains won't be as huge because the bottom is taking long to form. But now that we're getting the scenario of the final low, things are going to be extremely oversold. Obviously now, most stocks extremely oversold. They're down substantially. Throw another 20% or 25% losses on that, and that's the kind of condition that allows these stocks that, after all that selling's done and the new bull market begins, that's what allows substantial rises coming out of the bottoms. I mean, we're talking about juniors that can go up 50 to 100% in the first couple months following the bottom. I mean, I've studied this in the junior sector, and I'm talking about GDXJ, like the larger juniors. On average, they can rise 200% out of these major bottoms. So the bad news is I still see a lot of pain ahead in the next couple months, and I would urge people to protect themselves if they already haven't. But the good news is once that passes, then we're going to see a real new bull market, and then we're going to see huge gains, I think, in 2015. So, I mean, that kind of sums up where I am. I think we have a lot more pain coming in the next couple months, but it should set up for a real spectacular 2015. So hopefully people can really understand their situation, protect themselves in the next couple months, and put themselves in position to take advantage of these real dumpster fire type prices.
Listeners can visit thedailygold.com, check out Jordan's premium newsletter and the model portfolio. Jordan, thanks so much for joining us today.
Colin, thanks for the opportunity.